Hey there, and welcome to Lesson 1. In Lesson 1, I want to share with you a tax strategy called a Qualified Charitable Distribution, or QCD. Hopefully this will give you a new perspective on a lot of the old donations that you have been giving for years or plan to give well into your retirement. To share with you this concept of a QCD tax strategy, I want to share an illustrated story that really pulls out the benefits of using a QCD into retirement. In this story, we want to start with an individual named Lucy. Now, Lucy has been used to traditional donations throughout her working years and wants to continue to contribute to donations throughout her retirement. Now, Lucy has an RMD, or required minimum distribution, if you recall that we've learned from past sections, of $100 that she'll be required to take out of her IRAs this next year. She has a desire to donate $75 to a charity of her choice, as well as being in a 20% tax bracket. Now, in this example, Lucy has an IRA that she is required to take that distribution from each year. As you can see that as this $100 RMD comes to her, it crosses through what we call the veil of taxation, essentially causing every dollar to be taxed as ordinary income in that year. Now, Lucy, after receiving that $100 from her required minimum distribution from her IRA, she then realizes that she needs to pay taxes. You always got to pay the tax man first. So she pays 20% or $20 to the IRS and then fulfills her $75 donation desire to her charity of choice. After paying the IRS and paying her donation, that leaves Lucy with $5. Now, let's go around the table and see if everyone's satisfied. Is the IRS satisfied? Did they get their 20% tax? Yes, they did, in the form of $20. Is the IRA satisfied? Did they properly distribute the full $100 required minimum distribution? Yes, they are. Is the charity happy? Did they receive a $75 donation? Yes, they did. Is Lucy happy? Well, she received $5. I don't know if she's happy or not. Let's go on to the next example and see in comparison. Now, Lucy, after attending a retirement taxation masterclass, realizes that into retirement, there's a better way to make these type of qualified donations. So let's reset that, but assuming that Lucy still has a $100 RMD that she needs to take for that year, she still wants to make a $75 donation, and she's still in a 20% tax bracket. Now, Lucy contacts her IRA custodian and asks them to send that $75 donation directly to her charity. Now, if you'll notice, it has not crossed the veil of taxation, and she is not taxed on that $75 donation. However, she does need to take a full $100 distribution out of her IRA, so the remaining $25 does come in the form of a traditional RMD and does cross through the veil of taxation. Because of that $25 distribution, she does have to turn around and pay her 20% tax to the government. So 20% of 25 is $5, so she sends that to the IRS, and now Lucy is left with $20. Now, whoa, what changed? Lucy did have $5 in the first example, and now she has $20. Well, let's look back and determine fundamentally what changed. So we still have that RMD that needs to come out. We still have that $75 donation, and we're still in a 20% tax bracket. However, the order in which the distributions happened is what really makes the magic inside of this QCD. If you notice that the donation came directly from their IRA, not from Lucy. Hence, it wasn't taxed. Now, Lucy had a much smaller dollar amount that she had to pay to the IRS because her distribution from her IRA was less. So let's go around the table and see who was satisfied. Was the IRS still satisfied? Even though they got $5 versus $20, did they still receive their 20%? Yes. Was the IRA satisfied? Did they distribute that full $100 distribution or required minimum distribution? Yes. Was her charity satisfied? Did they still receive the same $75 donation? Yes. Was Lucy satisfied? In contrasting a traditional donation to a QCD donation, she ended up with $20 versus $5. Yes, Lucy is satisfied. Now, you might be asking, Devin, that's amazing. Why have I never heard of that before? Well, going a little bit into the history of a QCD and why it's such a little known strategy, We'll just share a couple of facts with you. Temporarily, it was part of the IRS code from 2006 to 2015 in an on and off fashion. They approved it for a year and then not for a year, and then approved it for 2 years and not for 2 years. And it kind of went back and forth as Congress tested it out inside of the IRS code. However, in December of 2015, with the passing of the Protecting Americans from Tax Hikes Act, the QCD was made a permanent part of the IRS code, which is great news for you. So what are some of the benefits of a QCD? This type of contribution is actually termed a perfect pre-tax contribution because these funds are coming from your IRA, which is a tax deferred account, meaning no taxes have been paid going into this account, and now no taxes are being paid as they come out. So essentially a perfect pre-tax contribution. Another benefit is that it decreases the taxable income, and by doing so has a positive impact on your Social Security taxation and your Medicare premiums. Meaning because the QCD portion of your RMD is not increasing your taxable income, there's a potential that you'll pay less taxes on your Social Security benefits and that your premiums will stay low because it won't force your premiums into a higher tier. And then lastly, simply put, it's less money that goes to the IRS. So there's a lot of benefits that come from a QCD. We want to make sure you're eligible for a QCD donation, and there are a few requirements, so let's touch on those. First off, the distribution must be made from an IRA, and it cannot come from a 401k, 401b, 457 plan, TSP plan, or any other tax-deferred retirement plans. It needs to come from an IRA. And second, you must be 70 and a half at the time of your distribution. If you remember back into our illustration with Lucy, she had to be 70 and a half before she could make that donation or request that donation to be made from her IRA directly to her charity. Third, your annual distributions must not exceed $100,000 per individual per year. So yes, if you have a husband and a wife with large IRA balances, they can each donate up to $100,000 per person. Next, the distribution must be made before December 31st of that tax year. And then lastly, the distribution must be made directly to a named charity and not an individual. This includes a foundation. So it must be a qualified 501c3 entity that you're making that distribution directly from your IRA to that named charity. A lot of folks ask, when is it a good fit? As you can see from our example, economically, there's a great benefit from there, but it really doesn't fit for all people. So here's a couple of thoughts about when is it a good fit for you. So if you're planning a one-time contribution or regular contributions into your retirement years, this possibly might be a great fit for you. As well as if you have a tax-deferred IRA balance when you're older than 70 and a half. And then of course, and lastly, this is a great fit for you if you enjoy keeping more and more of your hard-earned money and sending less to the IRS. Now, as we finish up this lesson, I encourage you to take out your tax story worksheet that we've been working on throughout this masterclass. Now, if you go down to part C on the bottom of that tax story worksheet, you'll see a section called strategies. And there's several strategies that are listed on there, and we'll actually go through those. If you go to the very end of this strategy, you'll see a qualified charitable distribution or QCD. This is where you would notate in your tax story if you feel like it's a good fit for you. Now, if you notice, it's all in the far right-hand column, which is your RMD years, which after you're 70 and a half, you'd qualify for. So if you feel like you're a good fit, go ahead and select yes on this, and then write in an amount that would be your desired annual donation amount. In the next section, we're going to talk about the impact or the benefit that you might have from making this donation. But for the time being, go ahead and select yes and write in a desired annual donation amount, and we'll talk about that on the next section. Great. That wraps up the qualified charitable distribution strategy. In the next lesson, we're going to talk about in-kind donation strategies. We'll see you in the next lesson.